Hello, my name is Evan, and welcome to Evanomics 101, your number one source for everything economics. The latest CPI report for March 2026 shows inflation jumping to 3.3% year over year, up sharply from 2.4% just 1 month ago in February. That kind of move doesn't just grab attention, it changes expectations across our economy. Today on Evanomics, we're breaking down what the CPI inflation report actually says, what's driving the sudden inflation spike, and what it means for the Federal Reserve and your money going forward. Before we jump into the video, I do have a quick favor that really helps grow the channel. If you enjoy content like this, hit the like button, share this with someone who needs it or needs to hear this, and subscribe so you don't miss out on what's coming next. I've got a lot more content like this that can help somebody understand economics better, and subscribe and make sure that you stay ahead. Okay, let's get into it. So what happened with the CPI, right? Here's the headline. U.S. inflation measured by the Consumer Price Index rose 0.9% month over month in March 2026, pushing that annual number up to 3.3%, all right? That's the highest inflation reading in roughly 2 years. Now, to put that in perspective, let's break it down so you can kind of understand what that 3.3% actually looks like. So last month, February, you got 2.4% inflation. This month, March, was 3.3% inflation. That's a fast acceleration in price levels, okay? But here's the important thing. Core inflation. Understand, core inflation removes food and energy. Core inflation is still around 2.6%, meaning that the underlying economy is not overheating in the same way headline numbers suggest. What does this tell us? It tells us that it tells us this is not a broad inflation problem. It's a shock-driven inflation problem. Okay. So and you probably are able to guess this. What is driving the shock-driven inflation? Okay. What's driving the inflation spike? The biggest driver is oil. The big energy. Okay. Specifically oil. Gas prices surged due to global supply disruptions tied to geopolitical tensions in the Middle East, which created bottlenecks in oil supply routes. All right, we get that. Strait of Hormuz, we talked about that in a previous video. And when energy spikes, it spreads fast. Transportation costs rise, shipping costs rise, food distribution gets more expensive, airlines and logistic costs go up for us, for consumers. All right. That's why you got a lot of economists that estimate gasoline alone accounted for the majority of March's CPI increase. We're talking about a situation where one category, energy, is driving most of this inflation story, this specific inflation reading. Okay. So what are we gonna get from the Fed? Now this is where you get it a little complicated. The Federal Reserve has been trying to guide inflation back toward its 2% target for years. But now they're stuck in the dilemma. Okay, if you raise rates too much, you risk slowing down your economy. If you keep rates steady, you risk inflation reaccelerating. Okay, it's stuck. All right. Recent Fed commentary suggests policymakers still believe the economy is fundamentally strong, but they are watching energy-driven inflation closely. Right, and this matters because markets are now repricing expectations. Fewer rate cuts expected, higher for longer interest rates becoming more likely, increased volatility in stocks and bonds. All right. Why does an inflation spike matter? Here's the takeaway, basically. Even if inflation isn't a broad-based, even if it's not over everything just yet, the psychology of inflation is back in the mix. All right, and that change in behavior, consumers spend differently. All right, businesses adjust pricing faster. Investors demand higher return. Wage pressure begins to build again. Okay, even a move from 2.4% to 3.3% is enough to shift expectations across the country. All right, quick pause, guys. If you're getting value from this breakdown, hit like button, share this with someone who follows the economy, and subscribe. Most people aren't tracking this level of detail, so if you are, you're already ahead of the curve. Let's hop back into it. The bigger economic picture over all of this. Zooming out, This is just about the CPI report. You know that. What this does is it highlights a reoccurring pattern in modern inflation cycle. Supply shocks still matter. Energy remains a dominant driver. Inflation is no longer purely demand driven. Even though core inflation is stable, headline inflation shows how fragile pricing systems can be when global shocks hit. All right. What you can expect to come next. So looking forward, there are three key things to watch for. All right. Energy prices, number one. Do they stabilize or spike again? My opinion, oil is going to continue to go up. Fed policy. Will they delay rate cuts further? Inflation expectation. Do consumers start pricing in higher inflation again? Because once expectations rise, inflation becomes harder to control. All right. So that was a little bit on the CPI numbers. If you found this helpful, make sure to hit the like button, subscribe, and drop a comment. How do you feel about the CPI numbers? Do you feel like that 3.3% is just specifically focusing on energy, or that spike is because of energy, specifically oil and what's going on with the conflict in the Middle East? Let me know. Let me hear from you. And as always, this is Evanomics, your number one source for everything econ. Please check out some of my previous videos, and I always have new content coming. I will see you the next time. Thank you.